Sure. Okay.
I think we should start because we have a good
Yeah.
number
Okay.
and people will join
Sure.
as we proceed. Okay. Good evening, everyone. I'm Akshat Chaudhary, a member of FEBS, the Society of Finance, Economics and Business of IIT Bhubaneswar. I would like to thank everyone for joining today's session. We at FEBS strive to educate everyone on the different domains of finance, economics, and business through a number of workshops, sessions, and competition. I would like to welcome Mayank Rasu sir, who shall be taking this session on algorithmic trading. He is a quant researcher and educator and has authored and published many best-selling courses and books on finance and technology. He is the vice president in Barclays Quantitative Analytics team and also the founder of Rasu Quant Limited. We're glad to have you here, sir. Over to you, sir.
Great. Thanks, Akshat. So, like Akshat said, this is going to be a more of a kind of an overview kind of a session. We would have some code along sessions, but unfortunately the markets are closed today. I would have ideally liked to conduct this during the market hours, but because you guys have your classes and all, we had this discussion with Akshat, so it was decided that we do it over the weekend. But it's okay. No problem with that. I think I should be able to give you a fairly good idea of how you can use algorithms to in the field of finance and have at least basic algorithmic trading setup that you can work with. How do I go to the next slide? Okay. So Akshat has already talked about me, so I'll not spend much time here. So again, I mean, I have always worked in finance. I started my career in 2007, just before the Lehman crisis. I graduated from NIT Warangal, lucky to get a job in finance, I would say, because I was not really interested in software engineering. I was hired in Deloitte, and then they had a new area coming up in India, which looked into derivative pricing, etc. So I got my exposure. So that was my first tryst with finance, and then I like that got me really interested, and I moved to North America. There I did my MBA and then worked there for some time, and then I came back to India. So all my career has been in the investment banking modeling domain, and it's a great area to be in. Uh, I mean, if so, I from IIT. I mean, people hire like all the firms hire all the time. So I would encourage if any one of you are interested, it's a fairly rewarding field. So and I have a slide on careers in quantitative finance towards the end of this presentation. So I'll talk more about that then. So back in 2019, just out of fun, I created a course on uh, algorithmic trading, and I just posted it on Udemy. Just for fun. I didn't really have idea or anything about that, and that kind of picked up. So a lot of people reached out to me saying that they really liked the course and they wanted to get more content out of me. So that is when I seriously considered, education in quantitative finance as something that I can actually work on the side, and it has worked out great so far. So right now I have like fairly good presence in the quantitative finance and algorithmic trading education space. I have close to 50,000 students worldwide, and yeah, you can find me if you Google me, so that's fine. I will come to that in a bit. So my interest, so I was told that like more than 100 people registered for this session, and that's pretty encouraging because when we were like when we were in my undergrad days, we had absolutely no idea what is algorithmic trading. We knew about investment banking, what happens and all that, but we didn't really know that algorithms could be used to automate the entire trading life cycle, and that engineers are hired in this field as well. But it's really great that uh, Akshat and his team is working on enhancing your awareness. And trust me, it's going to serve you really well because this is one area that is really gaining in popularity. It will probably hire a lot of engineering graduates in India in near future. So I'm just trying to understand your motivation for being here on a Saturday evening when most of you should be out doing something fun. But just want to understand why you attended this session. Do you think that it's very lucrative or you can become filthy rich by getting into algorithmic trading? Or do you think that it's very intellectually stimulating? At least it appears very intellectually stimulating, and that's your motivation to be here. Or are you here because there's a fear of missing out? You want to know what this is so that you are at the same plane with everyone else. Or the depressing part, which means that you didn't have anything interesting to do on a Saturday evening, and that's why you're here. I hope your motivation is one of the three and not the last one. And we'll talk about everything in detail, what and how of algorithmic trading, and let's see whether I'm able to convince you to actually start seeking career opportunities in this area. Okay. So okay, Akshat, just want to understand. I want to have this like intro, like a kind of interactive kind of session. So how do I interact with the students? Can they post questions? I know like unmuting
Yeah,
would be a bit of a logistic challenge, but how do I answer the questions if they have?
sir, we can keep a Q&A session at the end, or we have the chat. People can post their question over there.
Sure. Sure. I'll pause every 15-20 minutes if I think that something interesting has been shared, and then I'll let people post their questions. Okay, great.
Okay, sir.
So, so just think. I mean, again, IOB trading is a fairly it can be as complex as you want to make it, but I'm pretty sure all of you know what data science is. So just think of algorithmic trading as somewhat related to data science. I would not call it a subset of data science, but ability to handle data moving at large speed and large volume is something very important, and that's something that you learn in data science. The only challenge in algorithm in this field is that the data could be moving, so it could be real-time streaming of data, and you'll probably have to know how to handle real-time data using WebSocket engineering and things like that. For computer science students, I'm pretty sure you will get some idea about multi-threading and parallel programming and and WebSocket programming later in your in probably third year or second year of your engineering. So that's something that you'll have to handle here, which is something that you most likely don't handle in data science. But other than that, think of algorithmic trading as a very highly related field to data science. So the skills that you will gain in algorithmic trading are highly transferable to data science and vice versa. So that's something that I want you to gain some idea about. But at a high level, it is a highly interdisciplinary field, and the algorithms that go into trading are motivated from a number of fields. Obviously, knowledge of finance is important, mathematics is important, computer science and statistics is very important. But then there are other fields like psychology, behavioral science, etc., that are also being highly used in this field. So it's a highly interdisciplinary field, and a lot of research and a lot of work is going on in this area. And you have to keep pace with the new research that is happening to be able to thrive in this market, in this industry. The whole idea of algorithmic trading that you want to reduce human dependence on trading as much as possible. Ideally, you should have a trading setup which kicks off at 9:30 in the morning when the exchange is open. I mean, sorry, in India the exchange is open much earlier at 9:15 a.m. But typically, like in the US market, it opens at 9:30 a.m. So ideally, your algorithm should be something that you may have something like a virtual machine or a cron job or something like that that kicks off at 9:30 in the morning US time. It runs through it has certain algorithms that kind of parse data, analyze data, perform some mathematical operations, and then place trades and manage risk. And then at the end of the trading day, which is around 3:30 p.m., it closes off all the positions, and then that's it. If you have a complete automation of all these processes, that means you have a fairly sophisticated algorithm that you're running, and that makes you a pretty advanced algorithmic trader. And and let me tell you, that's not very difficult. You can have this kind of setup with as low as, like, 3 to 4 thousand rupees in investment per month. And I'm making a bold statement, but my courses have been able to help students set up their own trading systems with kind of kind of on a bootstrap budget, like shoestring budget. So it's something that you can do from your college dorms with your pocket money. So that's not that difficult. But again, different firms use different level of algorithms in their trading. So someone might only be using algorithms for their strategy implementation, and everything else is manual. Or someone may be using algorithms only to optimize certain aspects of the strategy, and then everything else is manual, right? So it depends on what part of your trading are you using algorithm. And you can still call yourself an algorithmic trader as long as you have algorithms in your trading, or as long as you are having computer programs interact with your trading strategy. You can call yourself an algorithmic trader. The level of sophistication is obviously going to be different for different people, but that's fine. Even if you are able to use a very simple computer program to automate even your basic order management activity of your trading, that's a big step towards this field of algorithmic trading. Okay, so just understand that. And like I said, the budget of an algorithmic trading system could be as low as a few $100 to as high as millions of dollars. Sky is the limit. There are like Renaissance Technology, which is the biggest algorithmic trading fund out there. They have millions of dollars of servers, located throughout U.S. exchanges. So it depends on how much sophistication you want, but you can have an algorithmic trading setup run from your college dorm, and you can be someone like, uh, you know, Citadel or Resenia, with millions of dollars of budget in the trading system. All right, so I just want to understand again. Would have loved to have a poll here, but I would assume like at least 30% of you would have some exposure to trading. You have, if you have not traded, you know someone who has traded, you know how a trading terminal looks, etc. So let me actually show you a trading terminal right now. So how do I unpin this? Yeah. So for example, this is the trading terminal of one of the brokers in India. It's called Angel One. So let me create this chart, right? So in the morning, if I'm trading, I might be interested in certain stocks. So, you know, which is a good stock? Let's talk about Infosys. Okay. So let's say I'm interested in Infosys. I would definitely, if I'm trading manually, I would like to look at this chart. And I hope you know what this chart means. This is called a candlestick chart, and a lot of people use this. So this is a daily candlestick chart. So every candle that you see here pertains to daily price movement of this stock, Infosys. So for example, on, let me look at a big candle, this candle. On 9th of December 2022, the stock opened at 1,568 rupees 69 paise. Sorry, this is a red bar. So red bar means it went down. So it opened actually, wait, how do I, it's not visible. Let me expand this. Yeah. All right. Okay. So this is not one. So I want someone with a candle and a wick. So you can see that. Let's look at this candle. Let me expand this. Yeah. So this candle has a body and a wick. Let's look at the last candle. It has a body and a wick. So if the body is green, it kind of looks blue, but let's assume that it's green. So it's green and red. So if it's green, that means that the stock did a gain for that year. So the close price of that stock in that day was higher than the open price. If it is red, that means that the closing price was lower than the open price. So if I look at this candle, that means the price that we had on 13th of Jan, the 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 stock opened at this price 1483.02. It closed at 1503.77, and then there is a wick. This wick tells you what was the high price of the day and what was the low price of the day. So high price was 1520 and the low price was 1468. All right. So this is called open, high, low, close information, or a candlestick diagram. And this also gives you volume information. I mean, how much volume was traded. In this chart, I don't have it, but I can add it. But it's fine. I just want you to understand candlestick, assuming not all of you have traded. So a lot of algorithmic traders are very interested in this level of information. How much is the price changing every day, or every 5 minutes, every 10 minutes? So this is daily data. I can change this to a more a more granular data. So I want to change from daily to 10 minutes, right? So this is the movement that happened every 10 minutes. What is the open, high, low, and close? Okay. So if you're trading manually, and you see a lot of traders doing this thing, so they will, be transfixed to a terminal, trading terminal. They would typically have 4 or 5 charts that are there, and then they are trying to look for some patterns. And as soon as they like something, they would click on buy or sell. So for example, if I like Infi, I'll click on buy. I'll put in my what kind of order it is, and then I'll place the order. So that is how manual trading works. One Another important thing in manual trading is something called technical indicators. So just by looking at these charts, you would not really get much information. But if you add certain technical indicators on top of it, you might have some better understanding. So let me get moving average. That's fine. Okay, so this is like the moving average of the stock prices. So moving average over a 9 trading period. So this kind of gives you what is the trend of the stock, whether it's going up or going down. So you can see that the Infosys, if I look at a 10-minute chart, it kind of had an uptrend, and just when the market was beginning to close, it started to go on a downtrend. So this is just one technical indicator. There are hundreds of technical indicators that day traders use, and based on that, they make trading decision. Sorry for this detour. I'm assuming that some of you have absolutely no idea about trading, and that's why I just gave you a basic of how manual trading works. Any question? Let me know right now. I'm just pausing for 5 minutes, and then we'll proceed on our algorithmic trading journey.
Anyone with a question, please ask it now.
That's fine. I think we'll have more questions as we proceed because this is a more basic thing. If you're not comfortable, you can simply click on the chat, and maybe I think there is a chat option to write things as well. All right, fine. So let us again go back. Let me share again. Where do I share? Great. All right, so this is how a traditional trading system works. You have a trading terminal in front of you. You're looking at a data feed. You are visualizing the charts. You're trying to perform the calculations. There are tools to help you perform these calculations. And based on that, you do manual entry. So how is an algorithmic trading system different from a manual trading system? So in algorithmic trading system, you have a trading application, and trading application may seem like a very, a very sophisticated term. It could be something as simple as a Python script. All right. So what your Python script would do is that it would interact with a server, and this server could be a physical server, or you could have a server using AWS or cloud server or something like that. And then this server would interact with the exchange. All tradings happen. No, okay, so this is changing now, but mostly trading happens on an exchange. So in India, if you want to trade, uh, it will have to go through either of the National Stock Exchange or Bombay Stock Exchange if you're trading stocks. If you're trading derivatives, there are other exchanges, right? So all trading happens through an exchange. So you need to have a way to interact with the exchange. So even when you are manually trading, like I just showed you, and when you click on the buy order on that broker's website, you may be using any broker like Zerodha or Kotak or or Angel One. What they would do, what the broker would do is that they would route your order to the exchange. In algorithmic trading, you are trying to cut out the middleman, and you want to directly communicate with the exchange. So for that, you will have to have a server because you want to get rid of the broker. But to interact with the exchange, you need to have something called a DMA or direct market access. And this direct market access is very expensive. You need to have net value, net worth of at least a crore for NSE to even consider you to give you direct market access. And you need to have, you need to deposit some capital with them. You can look at the NSE website. What are the requirements to have, direct market access? But many of my friends have been able to get direct market access. Uh, you know, some people can, get together, 5, 6 people can get together and raise some money, and then they can get a DMA and then set up this thing. So again, these things, the barriers to entry is going down. If there are 5, 6 smart kids, they should be able to raise sufficient money and set up this kind of a setup. So the first thing is to get the direct market access. Once you get direct market access, you can directly interact with the exchange, NSE or BSE or any other exchange, depending on what product you want to trade. But then if you are interacting with if you are interacting directly with the exchanges, they would ask you for your server because they would pass on the data to your server. And then this server could be, like I said, it could be a physical server or it could be a cloud server. And in this server, you would first store the data. So exchanges, as the trading happens, exchanges keep passing you the data. And I'll show you in a bit how that thing looks. So you need to be able to handle this fast moving data. And if you don't have a powerful server, you can very easily get overwhelmed because just think about the trading volume that happens in Indian exchanges. It's like billions of trades over, I would say, no, not billions, but millions of trades in one single day. So you have billions of rows of data that's coming in at a very fast speed, and you need to handle that. Okay, so you need to have a server that can do that. It needs to handle the data, both historical data and the real-time data. It needs to handle your orders, what orders you have placed, what is the status of the order, because this information is also shared by the exchange on the real-time basis, and you need to be cognizant of what order you have placed, what is your position, etc. So your server needs to handle that, and then it needs to have some kind of a very sophisticated event processing engine that tells that kind of decides what happens under given event. So for example, if market goes above certain level, do this. If there is a disconnection, do that. If there is an error, exit gracefully, and things like that. So you will have to have this event processing engine as well to be able to handle this. And one very important thing is co-location. If you have direct market access, you would ideally want to have your server in the same premises as the servers of the exchange. Because again, this we'll get to it in a bit. This is a bit of a high frequency trading thing. Because if your trading strategy depends on the speed of execution, if you want to be very fast, and that's very important for a lot of people because a lot of strategies depend on how fast you can execute a trade and whether you are faster than your competitor. And if you are able to do it faster, you have an edge over the other person. I'll tell you how this thing works in a bit through a strategy. Okay, so if the server is in Mumbai and if you place your server in Bhubaneswar, there's going to be a lag, right? Because signals have to exchange through this, although it's fast, although it's seconds, but still there is a lag, right? But if your server is in the same location as the National Stock Exchange or Bombay Stock Exchange servers, then you gain that speed, right? And that is called co-location. And a lot of exchanges allow you to do that. You pay them some money. This is called co-location rent, and you can actually place your server just next to their server within that location. So that is called co-location. So an ideal an ideal and a fast algorithmic trading setup should look something like this. Okay, so that's very important. But again, when you're starting out, there is no way you should. This is absolutely not recommended that you go for direct market access and try to have a server that costs lakhs of rupees and then try to place it with National Stock Exchange, which would again charge you thousands of rupees every single day. All right. So when you're starting out, you want to do it through a broker. So broker has taken care of everything. So broker has this server that talks to the exchange, and they take care of the market data and your orders and everything, and all that they give you is an API. Okay, and that's one thing that you should be very good with. So uh, any of you who are interested in this thing, uh, try to have a good idea about API, and you will get to know more about it when you study networks and all, what is REST-based connection, etc. So when you get that understanding, I think your understanding of API would be much better. So just think of API as a backdoor to a server. All right. So these are commands that help you make. Let me try to be correct here because it can be technically challenging to explain. API, just think of APIs as a protocol by which you can communicate with a given server through a different of protocols, but usually a REST-based protocol is used. And we'll get to that in a bit. Okay. So your trading application would simply use an API, and this API would feed off the broker server, and the broker could be Zerodha, it could be Angel One, it could be Kotak, it could be ICICI. Pretty much every Indian broker now has an API offering, and that is what you would use, which would cost you like just a couple of $1,000 a month, and you would have your trading setup ready to go. All right. So when you are starting out, this is the way I would recommend that you gain some kind of understanding of how trading works. Okay, before we get into, I think it's getting a bit boring right now with me talking all the time. So we'll get to exercises in a bit. But just quickly, let me tell you, how do you develop an algorithmic trading strategy? So the first thing is the design, right? And again, if you don't have any exposure to trading, I do not expect you to have, or I do not expect you to be able to, design algorithms right now. There are a lot of YouTube videos where people talk about strategies. If you want to start out, you can start out. You can use my course as well, where I have given like 5, 6 different kind of strategies that you can work off. But again, the more you are in the market, the more you will understand, the more intuition you will get of how to develop a strategy. What are the various things that are required to be able to come up with a profitable trading system, and it takes time. You're not going to make money as soon as you start trading, right? So it takes time. So this design part is very important. You plan every single moving part of your strategy. When are you going to enter? When will you exit? What happens if you get signal? So for example, if your algorithm is telling you that buy Infosys, and your algorithm actually bought Infosys, what if your algorithm tells you again to buy Infosys? Are you going to double down or are you going to stop? So things like that. So a lot of my students don't give, have suffered because they did not give consideration to every single moving part of the strategy. So that is why I insist that whenever you're trying to develop a strategy, is think of everything. Just think like a computer. Think like an exchange, right? Uh, if you are helping people trade, what are all the information that you need, right? And what are some of the things that can go wrong? So what if something go wrongs, right? What are a contingency? So what if your code crashes? What will happen? So for example, if you just bought 50,000 rupee worth of a stock and your code crashes, So what would happen? You have a long position. Now algorithm has crashed. What would you do? So think about that. What's the contingency? Are you going to manually go and close out the position, or do you have like a backup code that is running that will help you close the positions, etc.? What if the API crashes? And this happens a lot. And a lot of people have lost money with Zerodha because I think on every time there is a stress on their server, their API crashes, and then you are trying to you're trying to send sell orders or buy orders. It's not happening, right? So you end up with an open position, and then that's ugly. So what happens if that if these things happen? So you need to have some contingency planned when you are building your algorithmic trading strategies, and you have to code every single thing in your trading application. So it's very important to have like a modular code that handles every single event, and just just try to plan for every things that can go wrong. It takes time to understand what all can go wrong. You may burn your hand a bit, but that's how people learn, unfortunately. Okay, so and the very important thing is to incorporate risk management tools. Don't treat it like a casino. So if you have total capital of 1 lakh, don't put the entire 1 lakh on one stock, right? Try to have, try to split it, right? Try to have certain position sizing. Try to have like, that's a good thing about algorithm, that they are not emotional. So if you have set a stop loss of, 5,000 rupees, that you cannot lose more than 5,000 rupees in a single day. And if you lose 5,000 rupees on a day, all your positions would be closed, right? So you will have to code that in your strategy. So things like that. It's very important to incorporate risk management tools in your strategy. Otherwise, you're dead meat. So that's very important. And when you are designing your algorithms, you have to keep these things in mind. Okay. So discipline is very important. How far are we from? Okay, almost there. So yeah. So some other important things about trading system. So how do you build an an automated or algorithmic trading system? We have already talked about the direct market access. If you are looking for a high frequency trading setup, I'll talk about what HFT is in a bit. This is mandatory. There is no way you can have a high frequency trading setup if you're going through a broker or something. You have to have direct market access. But again, it's expensive, so that's something. Co-location we have already talked about. It's great if you can get co-location because you can get certain milliseconds over your competitors, and which is a pretty significant thing in this industry. All right, API trading. We'll talk about API trading. What it is, I've already talked about what are RESTful APIs. Most of the brokers in India provide RESTful connections. Pretty much like this is a standard. Even US brokers provide RESTful APIs. And it's very easy to work with RESTful APIs. These are good, but the problem is that they tend to fail a bit because they are based on HTTPS connection, and HTTPS is renowned to fail during stress situations. So that's a problem. These are easy, but there's a bit of a problem with this. All right. Mm, it's fairly cheap if you're using API trading. Uh, you know, if you're using Zerodha, they charge you 4,000 rupees a month. If you are using Angel One, etc., it's free. So depending on which broker you're going with, your cost could be as low as 0 rupees to a few $1,000, a few thousand rupees a month. Yeah, that's fine. Okay, so we'll get to that in a bit.
So
So
there's
yeah,
a question.
yeah,
Yeah, so I have posted a question. Could you please answer that?
yeah. Can you tell me? Sorry, I will have to stop sharing the screen. Can you read it out?
Okay, so the question is, do cloud computing providers allow algorithmic trading or is it restricted like crypto mining?
Okay, that's a good question. So if you are going through a broker, you are fine. There is no regulatory. There is no. I was trying to avoid discussion about regulatory things because it's again it's a kind of a hairy area to get in. But if you are in India, the regulators are fine if you are trading through a broker's API because brokers are compliant. So if you are using Zerodha's API or Kotex API or ICICI API, You can have your algorithms in cloud. Nobody gives a hoot. You can have any algorithm. It's fine, because you have to comply with the limits that are forced on you by the brokers, and those limits are forced on the brokers by the exchange. So you are compliant. So there is no if you are using an API of a broker, you can have any algorithm in your cloud. But if you are having a direct market access, then there's a problem. The cloud can let you do so. There's no problem with the cloud, but the exchanges would want to vet your algorithm. That your algorithm is not a systemic risk to the system, because there have been a number of cases in US or in other markets where certain algorithms have caused a flash crash, something like that. So if you have a direct market access and if you're running algorithms, you will have to first submit your algorithms to the exchanges. They vet it. There is a obviously, I mean, there is a clause where they cannot disclose or they cannot use your algorithm. So there is a legal requirement there, but they first vet it, they first run it and see that it's working fine, and then they let you kind of use it. So that is the thing. So if you have direct market access, then you will have to get it vetted. Cloud is not a problem, but the exchange is the problem. But otherwise, you're fine. All right. Anything else, Akshat?
No, sir. It's only
Okay,
one question. That's all.
fine. So before we get into the first exercise of for today, I just want to quickly talk about technical indicators. I just showed you candle. I just showed you, the open, high, low, close candle, and a lot of trading happens using that information. So there are three important pieces of information from financial market. First is the fundamental data. Fundamental data is if you have taken finance or economics course in your school, or I'm pretty sure um, in your college also, there'll be opportunity to get some certain electives. Uh, for example, if you're looking at Infosys, if you're doing fundamental analysis, you will look at the balance sheet, the income statement, how much income they have, how much spending they have, what is the revenue, how is the revenue changing, it is increasing or it is going down. This is called fundamental analysis. And for this, you rely on the disclosures that the firms make, typically after every quarter. Okay. So fundamental analysis is not typically used for algorithmic trading because the information comes once 3 months, right? So it's not that you're going to trade once every 3 months and then you're not going to trade. Algorithmic trading, the whole point is that you trade frequently, or at least you keep scanning the market. So fundamental data you can use, and I have covered certain strategies which can work in my courses, but typically in algorithmic and quantitative trading, there is limited use of fundamental data like the balance sheet, income statement, cash flow statement, etc. What we use is the candlestick data, the open, high, low, close information for the stocks. Uh, I mean, typically this is called a tick level data. So how is the price moving every kind of milliseconds or whatever, and then you aggregate it over a 5 second or 5 minute of 1 day period, and then you try to see how did the stock move, and whether I can use this movement to kind of predict how the stock is going to move in the next 30 minutes or 1 hour. Okay, so that is second level of information. And then the third level of information is called market microstructure or order book levels information, and we'll get to that a bit. And that is where the real fun begins. That is what the high frequency traders use. But most of the trading happens using the candlestick level information, the open, high, low, close value. And when you're using that information, then you're invariably using certain technical indicators. So when I was showing you the chart, I used a simple moving average, which is nothing but I hope you guys know what is moving average. So for example, if there's a time series for going back 100 days, and if you want to find the moving average where the moving period or the rolling window is 10 days, then you will take the 10 closing prices, the successive closing prices, and find the average. And then you will do that going down. Okay, so you would have 91 moving averages. Okay, so you take the average of the 10 prices from point 1 to point 10, then you take the average of from point 2 to point 11, then you take the average from point 3 to 12, like that. Okay, so like that you have the averages. So that's one simple technical indicator. All right. Uh, so again, there are two schools of thought. One school of thought says that fundamental analysis is important and technical indicator based trading is useless. And they say that because the markets are supposed to be efficient. So, this open high low close information, it's not really relevant. But having said that, a lot of traders are making money using technical indicators. So that is their response that this thing works. So, I mean, again, let's not go into the philosophical moorings of these schools of thought. The idea is that technical indicator works and a lot of traders use it. And there are a lot of technical indicators that you can use. Uh, there is something called moving average, convergence, divergence, which is nothing but what they do is that they use a number of moving averages, and using that they come up with a number. And if your stock price goes above that number, it means you should buy. If it goes down, it means that you should sell. Okay. Then there is something called Bollinger Band. I'll talk about Bollinger Bands in a bit. RSI, ADX, Supertrend, Renko. There are a number of them. Um, so yeah, you can uh, when you start trading, you would invariably familiarize yourself with these technical indicators, and it's very easy to code these. There are also third-party Python packages that provide functions to calculate these technical indicators, but it is very simple to actually write a function that calculate these technical indicators. So you can actually calculate these. You can write a code that calculates these technical indicators and then trade based on that. Okay, so at this point, I would want you to do something. I hope everyone has their, it was told that all of you know Python. So I hope that you have pandas library installed and that you have certain way of using Python. Okay. But first of all, I want you to go to Yahoo Finance. So let's go to Yahoo Finance. Ah, just write Yahoo Finance in Google and you will get it. All right. So Yahoo Finance. Then in the search tab, just pick any 5 stocks that you're interested in. They could be Indian or US. Okay. Let's go with Indian stocks. So let me if you are searching on Yahoo Finance, if it's an Indian stock, the symbol is usually .ns. But as soon as you will write Infosys or whatever, it will give you the ticker and where all it is listed. So if it says .ns, that means it's listed in National Stock Exchange. Now, this is the Indian stock. So Infosys is also listed in the US market. So we don't want that. We want this one. Okay. So click on this infi.ns and it will give you Infosys data. Okay. Within this Infosys data, click on historical data. You'll see that there's a tab here, historical data. Okay. And then you will see this historical data from Jan 14th, 2022 to Jan 14, 2023. And the frequency is daily. So this is daily open, high, low, close, and volume information. So what I want you to do is that I want you to download this. So this is 1 year of data, and I want you to click on this download button, and it will store this file here. Okay. Wherever is a download folder, it will store there. So let me click on infi.ns. So this is the data that you will get. Okay. So open. So it would you would have date, open, high, low, close, adjusted close, and volume. All right. So likewise, I want you to store 5 stock information. Okay. So we have infi. Then I give you some time. So I'm going to do for 5 stocks. And I have my screen shared. So if you want to use the same stocks, you can do it. Otherwise, if there are any 5 stocks or any 5 companies that you find interesting, I want you to download the historical data for that. So which one interests me in India? Let me think about it. Let's go with TCS. Again, tcs.ns. Okay, .ns. You want to go with .ns because that's the word listed in National Stock Exchange. Okay, historical price. Download. What else? Bhushan. What's the spelling here? Bhushan. Okay, forget it. Adani. Adani Ports. Okay, so Adani Ports, is it the NSI? Yeah, this is the one. Okay, historical data, download. So I have three, I'll go with two more. Wait. Let's go with ICICI. NSI. And one more, let's take a controversial stock, Yes Bank. Okay, yesbank.ns. Okay, historical data, download. All right. So I have downloaded the historical data for 5 stocks. I hope that you have done that too. So I'm giving you 5 minutes. 5 minutes. Okay, 5 minutes, fine. So now you have to read this Excel data in Python and store as data frame using pandas library. So I hope all of you know how pandas work. So import, first of all, import the the package called OS. This helps you interact with your operating system. Assuming you're using Windows, I think you can use it for any operating system. So I will use this to tell Python where are these files located. All right, and then import pandas. I hope you have pandas installed. If not, if you are using Anaconda, then you can use it using pip install pandas. Again, I don't know your level of proficiency, and if you're struggling, just post on the chat, and I'll try to help you. I think if you have an IDE like Jupyter or Spider, you can install using exclamation mark. So pip install pandas, and if you run it, this would install the package as well. All right. Okay. So the first thing that you need to do is first tell your Python where have you stored these files. So use chdir function. This is very similar to you clicking to the folder where the data is, and then give the path where this file is. All right. Let me quickly store these files
Excuse
in.
me, sir.
Yeah, go ahead.
So there was a question in the Google form.
Hmm.
I'll just read it out. Can we
Yeah,
use Google Collaboratory for hands-on?
yeah. Google Colab. The problem is, like Google Colab, you can do it, but you'll have. I want you to read these files from your local system. So if you know how to make that connection, do it. Otherwise, it's going to be a bit of a challenge. For the first exercise, you will have to sit out. After that, you can work. But right now, I want you to be able to read these files from your local system. So if you know how to do that using Google Colab, great. But I think it's a bit tricky. I've never used Google Colab, but my students have told me that it's not that easy. Okay, so just copy the location where you have stored these files, and then give the path using the raw string method in Python. Okay, so if I'll run these 3 lines of code, you will see here that this my working folder would change to where the files is. So let me run this, and you can see that um, now Python is in the folder where I have all the files. Okay, so if you so now what you have to do is write a code that will create a data structure like this. So make a make something like stock data, and I want you to have something like a dictionary. So this dictionary should look like this. It should have the key as Apple, oh sorry, as infi.ns or whatever, and then the corresponding value should be the OHLCV data frame. Okay, you have to import this. Then you would have second stock ICICI.ns or whatever. Then the corresponding value. Okay, so just create this data structure. I give you 10 minutes. It's not that difficult. If you don't know how to read CSV using pandas, do a quick Google search. I expect IIT Bhubaneswar students to be able to pick it up in 2 minutes. Okay, so I'm giving 5 minutes. Okay, try to create this stock data structure. It should look something like this. Okay. Okay, I hope people were able to do it. Let me look at the chat here. So Akshat, can I resume?
Yes, sir.
Okay. So I hope people were able to do it. So let me show you how you can do this. It's very simple. And if you know pandas, it's very straightforward. So pandas is again, pandas is is the most important, one of the most important data science, data science stack package in Python. It'll help you import data like, using one line of code. So let me show you how we can do that. Let me let me alias this, not use pandas all the time, right? So pandas dot read CSV. This is one line of code, and you can give the name of the file, and it will create a data frame which looks like Excel, and this would help you uh, create a data frame. So let me just give the name of the file. So the name of the file was infi.ns. So if I run this, let me show you what we get. What's the, sorry, infi.ns.csv. Let me see if this is the name of the file. Yeah. Okay, so you can see that we have been able to get the same data. This is a data frame, but right now we are not storing it, but you would have to find a way to store it. And you see here that once you read it, pandas automatically assign this 0, 1, 2, 3 index to our data. We don't want that. We want the index to be the date. It's a time series. So all these values are unique. So let's do that. To do that, we'll have to, there is a parameter that the read CSV function takes, and I think it is index underscore column. Index underscore column. Instead of, by default it is none. We'll have to say that date is the index column. All right. So index column, sorry, is equal to date. If I run this now, you'll see that now the date is the index, and this is like a time series. Okay, but you have to store this data, and you have to kind of you know uh, save it in this stock data dictionary. Okay, so how do we do that? First, let us create all the tickers that you are interested in. So our tickers are infi.ns, tcs.ns. What else I had? ICICI, is it bank or ICICI bank.ns? Adani ports and yes bank. Adani ports.ns. And finally, we had yes bank.ns. All right, so these are my tickers. So what I'll do is that I'll iterate through every single of these tickers, and then I'll import them using the read CSV function. I'll create a data frame, and then I'll simply append this to stock data structure, basic Python or basic programming. Okay. So let me first initiate this data structure. Okay. And then let me run a loop. So for ticker in tickers, stock data, key is going to be ticker, and then the value is going to be, sorry, I can type. So pd.read CSV here, we will, so instead of hard coding the name now, we can give ticker. Now we have to give dot CSV here, right? You can either do plus dot CSV, you can do string concatenation, or better yet, let me use Python format function. So the name of the ticker placeholder dot CSV dot format ticker. So I hope you guys know what is format, what format does in Python. If you don't, just look it up. It's a very useful Python function. All right, so this would create this data structure. Just one thing I would suggest to do. Actually, let me run it to you and show you what we have as of now. Okay, so let me run these 4 lines of code and let us see what we get. Okay, so the data was run. If I go to Variable Explorer, so Variable Explorer is a very good feature of the IDE I'm using, Spider, and that's why I use it, because it helps me explain to students what I'm doing. But again, if you're a developer, you can use more sophisticated IDEs like VS Code, etc. So you can see that we have a dictionary. These are the keys, these are the values, and the values are the data frames. So if you click on any of this, you will see that now we have got the open, high, low, close, adjusted close, and volume information for each of these stocks. One thing that you might ask is what is this closing price and adjusted closing price? So what happens is that stock prices can change historically. So for example, today the price of Infosys is 794.65. Tomorrow they may announce that, you know what, we are doing a stock split. So stock split means one stock of Infosys. So if you hold one stock of Infosys, from now it would become two stocks and the price would be halved. Okay, so if that happens, do we discard all the previous information because now the stock price is close to 400, whereas earlier it was close to 800? That doesn't mean that the stock value has halved. So you have to adjust the historical price as well based on the corporate action. So things like dividend, things like stock split, etc. If that happens, the closing price historically changes. So that is what the data providers do. They adjust the closing price, and that is called adjusted close. So if you're using some analysis, prefer to use adjusted close. All right. So now we have this information. So this is all that you had to do in your first exercise. There's one thing I want to check. Uh, there are certain Sometimes Infosys gives duplicate values if there is a dividend. And if that happens, you will have NaN values and you will have a duplicate date. Let me see which of these is a dividend paying stock. I think Infosys is. Yeah, Infi. I think it would have a duplicate date. Let me quickly check. Okay. You know what? There is a function to check whether there are NaN values or not. Is na, you can do that. But I'm pretty sure that if there is a dividend, what Yahoo Finance does is that so for example, if Infosys had paid a dividend on 19th of Jan, they would add 19th Jan here, and all these open, high, low, close would be NaN, and then there would be this dividend value. And if that happens, there's a problem. So uh, what we do here is that we drop that row having the NaN values. So just this thing that you have to add. Okay. So why am I getting an error here? Let me quickly run this. Yeah. Yeah. Okay. So that's the only thing that you will have to add. That yeah, in case there are NaN values, we just drop them. Okay. So all this that I did, all the shenanigans could be. So you don't need to go to Yahoo Finance and extract all this data and then try to read it into Python. And the whole point that we are reading this in Python is because we don't want to do manual. We want to have as less of a manual interface as possible. So ideally, you should run a code. It should get all the data, and then you should be able to do all the all the calculations that you want to do, and then trade. So there is a very good library called yfinance. So import yfinance as yf. You will have to install this using again pip install yfinance. So what yfinance does is that it lets you import the same data that you did without going into Yahoo Finance or any other portal and then downloading the CSV or an Excel format. It directly gets the data from the server of Yahoo Finance. All right. So the function that you have to use here is yf.download. Okay. So yf.download, and then all you have to give the name of a ticker or tickets. So for example, if I go with infi.ns, and that's it. If I run this, I will get the data. But by default, I will get a lot of data. So it's always good to tell Yahoo Finance what is the period and what is the duration. So period and period, the possible values in period you can see here are 1 day, 5 day, 1 month, 3 months, 6 months. So let me get 1 month of data. So period is equal to 1 month. Uh, Period is equal to 1 month. And then there is another thing called interval. So interval tells you what granularity of candle do you want. The open, high, low, close volume. Do you want it for 1 day? Do you want it for 10 minutes or whatever? So these are the possible values for interval: 1 minute, 2 minute, 5 minute, 15 minutes. So let me go with 5 minute data. All right. So interval 5 minute. Most day traders use 5 minute intervals. So that is also which we'll use. So 5 minute. So now if I'll run this, sorry. Okay, so now if you run this, you will see that you will get the exact same data. Okay, so you don't, so this step eliminated the need to go into Yahoo Finance and manually extract financial data into CSVs. Okay, because now you have a way to get all the data you programmatically within your Python, and then you can perform, and then you can apply the entire power of Python's data science stack and do any analysis that you want in Python, and then take trading decisions. So this is just one example of a basic algorithm that you have added into your trading that automates data extraction. All right. So I hope you understand how you have to enhance your algorithmic thinking and then try to automate different steps of your trading. So now I don't have to worry about data. I have a way to extract the data on the fly. I can write a code that can perform this step every 5 minutes or every 10 minutes or every 15 minutes, right? So things like that. All right. So at this point, I'll pause. If you have any questions, let me know. Otherwise, we can continue. I think it's already more than 1 hour. I'm trying to wrap it up. I don't want to keep you guys waiting here on a Saturday evening. So let me know if you have questions. Otherwise, we can proceed. Are there any questions, Akshat?
No new questions, sir.
All right. Give me 1
We
second.
can proceed.
Fine. Next step. All right. So this is a second exercise I want you to do. So hopefully you have been able to get your this stock data structure. Now all that you will have to do is do some analysis and tell me which stock is the one that you would be interested in. And a basic analysis would be to find the mean daily return, the annualized return, or the absolute return for each stock. We're running out of time, so let me show you how to do it rather than you doing it, because we don't have much time anymore. So let's see. So we have the stock data here, right? uh, Let me use the stock data. So now I want to see what is the mean. So what is the mean daily return for each of these stocks? So what's the way? So so how would you calculate a daily return? So daily return would simply be the ratio between this price by this price, and we'll have to do that for every single day. So let's do that. Okay, so for ticker in tickers. We'll have to do that for every single stock. So stock data ticker. Let us create a column called daily return or something like that. And that would be equal to the adjusted close column. And then pandas allow you to calculate this daily return using a very simple function called percentage change. Okay. So if I'll run this line of code, you'll see that for each ticker now, we have an additional column, and that tells you what is the daily return. So on 21st of Jan, the daily return that this stock had was minus 1.9%. Okay. And you can see that this stock has been going down in price. So that's not surprising. Okay. Now this is the daily return. Okay. This is a daily return, but we have to annualize it. And how do you find the annual return? So there are multiple ways. You can either take the mean daily return. Let me do that. So print annualized return. So annualized return is equal to format. Now let us calculate. So now we have this column. Okay. So we'll have to calculate the mean of this column. So dot mean. All right. But this will give you the mean daily return. You have to annualize it. So when you have to annualize it, you simply multiply it with the number of trading days in a year. So in this case, we have 252 trading days. Typically, we have 252 trading days if you remove the weekends and everything. So this will calculate the annualized return for each of the stocks. So let us see what is the annualized return for each of the stocks. All right, so it looks pretty, oh, sorry, annualized return for ticker is equal to this. So format ticker. Now if I run this, so annualized return, I'm not sure if you're able to see this because yeah. So annualized return for INFI was minus 19.3%. So last year was pretty bad for tech stocks. So it is telling you that if you invested in INFI at 14th Jan 2022 at the start of the previous year, you would have lost 19.3%. For TCS, you would have lost 13.6%. For ICICI Bank, you would have made 9.7%. For Adani, you would have made 8.6%. And for Yes Bank, you would have made 46%. And that's because, again, Yes Bank is a turnaround story. I don't know how close you are to the financial market, but there was some corruption issues with Yes Bank, and that really tanked its stock. But now there's a turnaround, and that's why you have this level of this thing. Okay, so using this basic analysis, you can make up your mind which stock you're interested in going forward. So now, if you have some money, and if you want to invest, if you want to see which stock to choose, you can pull data for like 200 stocks and then quickly get what's the mean return or mean annual return that we got for a given stock, and that will give you some idea about how that stock is. All right, so this is very basic quantitative finance that you can do. But do you think that mean is sufficient? Do you think you should only look at the mean return? Think about it. So ICICI Bank, you got 9.7%. But it may be the case that ICICI Bank gave you this return with much less volatility. Volatility means a stock, how much a stock moves. For example, why do you want to invest in, when you go to your parents, most of them say, you know what, invest your money in fixed deposit. Why? because it has zero volatility. The value of your investment doesn't change. It has a fixed interest, and every single day, that is the interest that is accrued to your money. Okay, so it has zero volatility. There is no change. If you invest in something like a bond, right? So bond doesn't change that much every single day, but stock prices may change, and some stock prices change a lot compared to others. So for example, if you invest in a penny stock or a mid cap stock, you will see that the stock price changes a lot day over day. But that's not the case with some of the established stock like Infi and TCS. So you should always measure your return against the volatility. That's a basic thing in finance. If you take finance ever, this is the thing that you will learn. So let us also see what is the annualized volatility for each of these stocks, and that will help us, make better decision of which stock we are interested in. All right. So volatility, annualized volatility for this stock is equal to. So now, instead of mean of daily returns, we will have to find the standard deviation of the daily returns. All right. So standard deviation of daily return is your volatility. All right. And then again, you'll have to annualize it, but this time not with 252, you'll have to multiply it with the square root of 252. And don't ask me why, you will have to know a bit of finance for that. But let me, okay, we have to do square root 252. So okay, so let me now run this. I knew I screwed up something. Okay, 1 second. I think I didn't close the. What did I do? Sorry, 0.5. Wait. Okay. Okay, so now you have a more detailed information. So Infosys gave minus 19% return, but the volatility was 27.6%. Okay. TCS gave minus 13.6%, volatility was 23.4%. ICICI gave 9.7% with volatility of 23%. Adani Ports 8.6% return with volatility of 34%. Yes Bank gave you 46% with volatility of 44%. All right. So now you can, make a better judgment of which stock interests you the more. Usually there's something called Sharpe ratio, which takes the return and the volatility, and it's a ratio, and then that ratio tells you how good an asset performed. So again, I don't want to take you the finance path. I'm just trying to give you an intuition of how you can use code or algorithms that can, extract data, perform some basic operations, and then give you a signal which stock to buy or which stock to sell. Okay. So this is at a very, on a scale of 10, this is like the 1.5 of algorithmic trading. Okay. If you are able to automate this step, you are at the right path. So this was all that I wanted to do in the second exercise. So now let's quickly, if you have any questions, just keep posting in the chat, and then I can take it forward. Okay. So now let's go forward. You know what? I wanted to have. Okay, so let me quickly go about this. So Bollinger Band is a technical indicator. Okay, so Bollinger Band simply tells, how. Let me open it. So how has the volatility changed for the stock over the period? Okay. So for example, in this, in this image, you can see that there are certain periods in which the stock became more volatile. Yeah, you can see that it has become more volatile, and then in certain, and then kind of, and then when it becomes more volatile, this band widens, and when kind of volatility subsides, this band kind of narrows down. So usually what traders do is that whenever this thing widens, that gives you an impression that correction is going to happen, or whenever the price of the stock kind of breaches the upper or the lower band, that gives you a signal. So for example, in this case here, you can see that the candles have breached the upper limit of or the upper band of this particular technical indicator. And this is a signal that the stock will go down. And you can see that this is exactly what's happened. So when the breach happened, after that, the stock went down. Likewise, whenever there is a breach on the lower band, it's an indication that the stock might go up. And you will see that more often than not, when that happens, the stock kind of rebounds. All right. So this is one technical indicator. I wanted to show that to you as well, but again, we don't have much time. So what I've done is that I have shared a helper functions file with Akshat. And he'll share it with you. So I have shared the Bollinger Band function. So try to play with this Bollinger Band function and try to create this Bollinger Band. And it will also create the plot, and it will help you visualize, how a given stock. So for example, just create the Bollinger Band for Infosys and just try to, come up with an answer whether you think that Infosys stock price is going to go up or down based on this particular technical indicator, right? So just play around with this, and then you'll see that you will get some insight about a given stock. Okay, so this is a basic technical indicator level analysis that I wanted you to get familiar with. What did I do? Sorry. Okay, so I hope that you'll be able to do this exercise yourself. Quickly. Yeah. So now we are at the fun part of algorithmic trading, and this is, I would like to say, the real algorithmic trading. This is the latency play. Latency means, in computer science, you will learn about latency. I mean, definitely you will learn about latency because I'm pretty sure you know about the big O notation and all that. So that also takes into consideration, time of execution and things like that. So this is what latency deals with. It tells you the time between a request and its execution. And this is a critical piece of information in high frequency trading. Okay, so a system that is optimized to process very high volumes of data messages with minimal delay is called a low latency network. These networks are designed to support operations that require near real time access to rapidly changing data. And this is and there is it is more true than anywhere else in the financial market. You have a large volume of data coming to you every second. You have to parse it, you have to analyze it, you have to, make find some intuition out of it, and then you have to make a trade, you have to do execution. And all this needs to happen in millisecond. Actually, millisecond is now very slow. People have moved into microseconds, right? And then that depends on how much money you have and how much money you can invest in your infrastructure. So again, this is like the cutting edge of quantitative finance. And a lot of big banks like JP Morgan and these funds like Citadel, etc., they hire a lot of very smart computer science engineers. Like you should be really good with these parallel programming and efficient programming and computing at scale concepts to be able to crack these roles where they're very difficult to get. All right. So these low latency algorithmic trading systems are also called high frequency trading or HFT system. They are very expensive and they require direct market access, co-location, and some very smart computer engineers. All right, so that's something to be aware of. And I've shared an article, and it's an excerpt from a novel called Flash Boys by one of my favorite authors, Michael Lewis. And this will tell you, this is a very good introduction to what high frequency trading is and how it is being used. Like again, this is a bad use of this novel talks about a bad use of high frequency trading, which was kind of not very ethical. But there are ethical ways of using high frequency trading as well. And it's a good read if you have time. Just go through this article and you'll find it fun. It's a good Saturday read. So now let me talk about some of the strategies based on order book. And this is what high frequency traders usually deal with. Okay, so again, it's going to be a bit challenging if you don't have any idea about the markets, but let me tell you how trading works in the market. So when you when you go to your trading terminal, okay, where is my trading terminal? Okay, so when I so say I am in my trading terminal, okay, and I click on the buy button, okay, let's go to intraday, right? So here it will tell me what price do you want to buy Infosys stock at. So I might say, you know what, 1503.35. So maybe the stock right now is at 1503.65. I want to bid my price slightly lower than that. Okay, so this is my bid price. And then I will tell you, and then they will ask how many do you want to buy? So 5 or 10 or whatever. So this information, guys, give me 1 second. I have to take a call. Give me 1 second. Sorry about that. Okay, so once I punch in all this information, and once I click on place buy order, this information would go to the exchanges. Okay, it will go to National Stock Exchange, and like me, hundreds and thousands of other people have also placed their order on Infosys. So let's say I have placed 10,000 stock orders for Infosys at 100.5, or any stock. The price is 100.5, and I've placed an order to buy 10,000 stocks. Then Akshat has placed an order for $100.3, and he wants to buy it, and he wants to buy 4,000 stocks, right? So likewise, you have all these people who are interested to buy the stocks. Same likewise, there are people who want to sell the stock as well. Okay, so for example, another guy, he wants to sell a given stock at $100.8, and he wants to sell 5,000 stocks. Second guy wants to sell at 101 for 33,000, and he wants to sell 33,000 stocks of a given stock, right? So this is called order book. This is called the market depth or market microstructure. So right now you can see that there is a mismatch. The buyer wants to buy it at 100.5, the seller wants to sell it at 100.8. And then, nothing is happening, no trade is happening. As soon as a buyer comes that puts in a price of 100.8, this transaction would happen. And then this line would remove from my order book. And then 101 would become the most favorable sell price. Okay, so this is how the markets get cleared. And although this may look like a very useless information to you, this information is gold mine. And if you are able to get this information at if you're able to get correct information, I mean, usually order book information could be a bit delayed, etc. So if you are able to get the actual latest information, and if you are able to manipulate it using efficient algorithms, etc., that is what HFTs do day in and day out. All right. So the idea is that if you have a very good visibility of this order book, you know which way the wind is blowing, whether people are interested, whether more people are interested in buying a stock, or whether more people are interested in selling a stock. All right, so let me show you an example. So this is an order book. Just look at this order book and tell me whether you expect this stock to go up or down in the near future. I've already given the answer, but just think about it. So this stock is going to go down, okay? But just think, why do you think that would happen? Think about it. This is a very important. If you're able to get this, that means you have the intuition to be able to do well in this financial market. So these are the buyers, these are my sellers. And just looking at this, I can tell that the stock would probably go down. Okay, so I hope we were able to talk, but in this case, let me tell you what's the answer. So you can see that the sellers, look at the volume on the seller side. 5,000, 33,000, 12,000, 2,000. So a lot of people are desperate to sell this stock. And on the buy side, there are not very many people who are interested, right? So just think about you going to a fish market, or a let me think about it. When did something like this happen in near future in India? In near past in India? Was there any shortage of anything? Just when Corona was happening, it's a very bad example. But when the Delta, when the second wave, I think it was Delta, right? So Delta strain was ravaging India. So just think about what was happening with the hospital beds, right? So hospital bed, the price was 5,000. There are 15 people who are trying to get that bed. Price is changing. You're bidding. You know what? I'll give 8,000. Let give bed to my near and dear one. Other person is bidding. You know what? I'll give 15,000. So the price is changing, right? So there is more buying pressure, right? There is less selling pressure. So obviously the price is going to go up. Likewise, if you go to a fish market and if the stock of fish is going down or something, you will see that the price is very rapidly changing. If there is more buying pressure, if there is more selling pressure, the seller has to just sell his stock and go home. He doesn't want to let his fish rot if he's not able to sell. So if the inventory is large and people are not, and there are not a lot of buyers, he would have to drastically reduce the price, give you a discount, etc. So the same thing happens in the market. Markets are very interesting. If you are able to see the market in real time, you will see the beauty of the market, how the markets get cleared. Okay, so that is what the high frequency traders are doing. They're trying to see, they're analyzing this order book on a real time basis, and they're trying to make very quick decision whether the stock is going to go up or down in the near future. But with technology comes bad people as well. So again, there is something called ethical algorithmic trading and there is something called unethical algorithmic trading. And there are a lot of people who do unethical algorithmic trading as well. So using this strategy, 5 years back, you would have made a lot of money. If you had a server co-located with National Stock Exchange, and if you were a very good C++ programmer, you could have written a very good code that streams this data quickly and then tries to figure out if there is increased buying or selling pressure. But then this market was completely queered by spoofers, right? So spoofing refers to the illegal act of placing fake orders with no intention to enter the trade with the objective of simply manipulating the market. Now let's think about another. Now let's think about Now let's say you own stock A. You are a hedge fund. You own some stocks of HDFC, and you want to sell it. Obviously, you want to sell it at a higher price. So right now the price is at 100.5. You want to sell it at a higher price. You want somehow for the stock price to go up. What could you do? You could place some spoofed orders. So you could say that, you know what, I want to place 400,000 stocks of HDFC at 100 point at slightly lower price than the market price, right? So when you post orders like this, other people or other algorithms that are analyzing market microstructure would see this and think that, what the hell is happening? So that algorithm would say that this stock A is going to go up because there is a higher buying pressure. But these are spoofed orders, right? You have absolutely no intention of honoring this. So as soon as you start placing the spoof orders, algorithms read the market incorrectly. The stock price starts to go up because people start to buy the stock, and then you can dump your stocks. So this happens a lot. It's very difficult to catch spoofers, but this happens a lot, and because of this, this strategy no longer works. It used to be very profitable, but now because of spoofing, this doesn't work anymore because you don't really know, uh, you know, whether this information is correct or not. Okay, and in one of my courses, I have shown real-time spoofing. You can actually see how spoofed orders are coming in. So 1 second you will have, all of a sudden you will see a big order, 5 million or something, and then in the next order you will see that that order has disappeared. So the sole intention is to kind of manipulate the market and get a small time increase in the stock so that you can dump. Okay, so just quickly, we are getting to close of our presentation. So these are some of the challenges of high frequency trading or order book strategies. This spoofing exists and it's very difficult to get rid of it. And also you need very significant computational power to be able to analyze order book on the real time basis. Okay, so that's very important. It's the last exercise, and then I want to, you know what? Let's not worry about the exercise. I'll quickly show you how this data streaming works. So this is a video from one of my courses where I am streaming data from Angel One. So I'll quickly show you. So this is the code that I have. So if you run it, so you can see that as this code is able to get all this data on a real time basis, and this is the market microstructure data. And this may seem a bit strange to you right now, but let me show you how this data looks. I've actually stored it for you. So, and I've shared this data with Akshat, so you can get it. So this is a sample data. Okay. So these are the ticks. So this streaming is for 3 stocks. Okay. And the stocks, you won't get the names. Every stock has a token in the exchange. And right now you can see that I have got 3 tokens. Token 1594. I think this is ICICI. Then there is token 2885. I think this is ACC Cement. And then there is 11536. I think this is ICICI. Okay. So these are all the ticks that I got in a span of, I think, 7 seconds. So I started streaming at 3 3 3 p.m. 3 minute 4 second, and I went all the way till 3:17. So these are all the ticks that I got in the 13-second time frame. All right, and this is the order book. So let me show you the order book. This, you can see that this is the order book. So yeah, so bid price 1886.51. Bid price 1, that means the next bid price is 1886.50. Then the next bid price BP2 is 1886.45. Likewise, you would have 5 prices. Okay. So these are 5 bid prices, which is nothing but this part of the exchange. Where is that? Okay. This part of the exchange. So these are 5 bid prices. Likewise, you have the bid quantities. For each bid price, what is the quantity? So 737 stock. So at this point, when I was streaming, there were order to buy 737 stocks of Infosys at the price of 1886.55. Then the second best order was for 191 stocks of ICICI for 1886.50. Okay, so likewise, I hope you understand. So this is the order book information, and you can stream it, you can store it, you can process it in real time. And this is the fun part. So if this is the actual, I consider this as the actual algorithmic trading, because this requires the highest level of skills, your computer science skills. Okay, so I'll quickly trying to finish off. Okay, so what else? So if you can, again, I have shared the helper code. So this helper code parses this order book. So the order book that we just showed you, you can see that this code goes through this, goes through this file, and it parses and it shows you what information you need. So you can use this helper function. You can expand this helper function and try to see if you can get some intuition out of this, this tick level information, the streaming information. All right, so that's done. So now towards the important part. What are all the skills that are useful uh, in uh, in this field? So obviously, if you are data science, I mean, most of you would be very proficient in data science related concepts. And if you know data science, you know 50% of algorithmic trading. Okay, because handling data is the most important thing in algorithmic trading. You should be able to handle historical data, real-time data, order data, risk management data. So if you are comfortable with handling data, uh, that skill is very much required in this field. API handling is very important. You would encounter APIs even if you have co-location, even if you have your own server. NSE is going to give you some APIs. The exchanges are going to give you some APIs. So you should be very good with APIs, how to write, how to create APIs, how to use APIs, how you can, handle, events and things like that. Okay. WebSocket programming is very important because just like I showed you, real-time streaming data is very important. and you should be able to know how to handle real-time data. So WebSocket programming is very important. So try to get a good handle on it. Parallel programming concepts I can't stress enough. In high frequency trading, efficiency is everything. So the more courses you can take on parallel programming, the better it is. That would really prepare you well for a career in the cutting edge of algorithmic trading, like high frequency trading, etc. If you are a if you have been able to you know handle streaming data at scale, that's the kind of person algorithmic trading firms are interested in. So you will see a lot of people who have worked in Twitter before, etc., working in these funds like Citadel, etc., because they have been able to work with real time data, etc., at scale. So so parallel programming concepts are very important, and I mean this is only for HFT, because again, like Python is easier. It's fun language, but it's slower, right? So if you're interested in HFT related roles, you need to know some C and C++, because that's what all the algorithms are written in, just for the efficiency. Because C is a lower level language. It's difficult, but it's much more efficient. There is no kind of overhead, very little overhead. So you are almost working with the machine language. So there's very little latency. So that's why if you want to go into HFT, C++ is a must. But for every other job, quantitative finance job and all that, Python works. So Python, C++, if you know both of them, you are very attractive to the potential recruiters, which I'm going to talk about now. So again, it's a very growing field, which has a lot of open roles. Even in India, you have a lot of firms. There are different kind of roles in quantitative finance and algo trading. The big banks hire for derivative pricing, model, for forecasting kind of roles. Uh, but there are a lot of actual HFT firms that hire computer scientists or engineers. Uh, for example, World Quant, Trex Quant. If you're interested, I think Trex Quant has, sorry, I think Trex Quant has, if you go to their website, I think they have some kind of a fellowship where college students can actually work with them. They pay you a stipend, I think 50,000 rupees or something, and then you can work as a research assistant for one of their funds. So again, I think WorldQuant also had a program like this, but I think they have scrapped it. So WorldQuant, TrixQuant, these three are the big three in India for HFT: AlphaGrep, QuadEye, and Tower Research. So these three firms are the top firms in. So they do all these kinds of freaky algorithms like order book management and execution speed and things like that. So again, it's difficult to get into these organizations, but you can. I mean, they hire people all the time. So if you are interested, you can try for internship in these organizations as well. Graviton, again, up and coming HFT firm. And then there are many small shops, like Kotak and Zerodha and Marwadi Group, etc. So they want engineers, or they want people, or software engineers, or even finance researchers who are able to work with API and who are able to kind of work with data and able to kind of give them some insights. So this is just a small subset of firms. Again, the big banks like JP Morgan, Barclays, etc. Like, we have our hiring, but again, we have very structured hiring. We go to specific schools, etc. We just recently completed our hiring. These banks typically, for you guys in college, typically, like there are relationships, existing relationships. So reach out. So tell your training and placement coordinator to reach out to these banks like JP Morgan, Goldman Sachs, Barclays, Morgan Stanley, and they'll be more than happy to consider, right? So because you have a good brand. So that is what I would say. And again, if you want to get a better understanding, there are some of my Udemy courses. None of them should cost you more than 400 rupees. They're always on discount. It would cost you less than your 1 day of outing outside. So if you're interested, these are some of the stocks that are relevant to you. Most of my courses are relevant to investing in US or international market, using interactive brokers. But I think this is a basic course, that talks about basics of quantitative finance. Then I have a course on building trading algorithms on Zerodha's platform using Kite Connect, and then I have a course on Angel One. Angel One is free, so if you have an account with Angel One, you can actually play with these algorithms, and it will not cost you any money. Okay. So yeah, so that's pretty much it. Thanks a lot and best wishes. Let me know if you have any question. You can if you are too shy to ask your question, you can drop your questions to Akshat. He can send it to me. I'll try my best to respond. But yeah, let me know what are your thoughts. There are 18 questions. I think there are some hand raised. So I think we can have some 10 minutes for Q&A. I think we are just. I think we have 1 minute, 11 minutes short of the time. So you can open up if you want, Akshat, and we can have some Q&A.
Yeah, there was a person who wanted to ask a question. I'll just let him ask.
Yeah, you can unmute.
Hello.
Yeah.
Am I audible?
Yes, yes. Go ahead.
Okay. Hello, sir. First of all, it was a very great lecture.
Thank you.
Thank you so much. I have a question regarding the Nifty. I am also a trader.
Okay.
So it's a real-time example.
Mm-hmm.
It's regarding index. Okay, and
Okay.
related to index-related stocks, which
Okay.
moves related to the index.
Yeah, yeah, yeah. Yeah.
Uh, Sir, up to 29th of December, we were in the upward move, right?
Yeah.
But when the rumor of Corona suddenly started, so at
Yeah.
the on the 30th December, the stocks suddenly crashed. Every stock almost crashed by 5 to 10%,
Yep.
right? And from when the new year starts and the new opening started from 2nd of January to
Mm-hmm.
till now, we are consolidating between the range of 7850 to 1800, and upward support is 18,200 and 250, right?
Okay.
Right. So from 2nd January to till now, 14th or 13th of January, every indicator is failing to predict what's going to happen, right?
Yes.
Correct me if
Yes.
I'm wrong.
Yeah, yeah, that's
Okay.
true.
uh, right now, how what is happening is, I'm a means I invest in everything, like long term trade, short term trade, intraday. I do everything.
Okay.
So right now it is very difficult for me to trade in intraday. Okay, I can trade only 2 days when it is at support level 7,850,
Okay.
850,
Okay.
and at
Okay. Once again, let's not discuss about individual strategies and all that. I want to keep it high level. But yeah, the one thing I get from you is that right now all TIs are failing, and that
yeah,
happens all
exactly.
the time. All the time.
So
So yeah, I mean,
what
first of
should
all,
we do?
are you trading manually or do you have an algorithm?
Sir, actually, I study everything, sir. First, are news, then I use my indicators like moving averages, RSI, and volume.
So you trade manually or do you have an algorithm? So do you
Sir,
go
currently
to
manually.
okay, so try to so again you I'm assuming you are an IIT Bhubaneswar student. So
Yes, yes, I am a
whatever
PhD
you're
student.
doing, yeah. So try to like if you are able to automate any part of your trading using the APIs, that'll be a great. I think I've done you a great service. If you can automate, any data analysis part of your code of your strategy, that would be great. But like you said, yes, technical indicators are not working, and this is not the first time this would happen. It happens a lot. But
Even I
as
wrote
you
one code also for regression.
okay, regression based strategy will not work. Let me tell you right now, it will not work.
Yeah, yeah, it's
Yeah,
not working at all.
it will not work. So try to, if you are interested, try to read more about behavioral, like in these market when everyone is scared, some behavioral economics based concept, like strategies really work, or positional kind of trades work. So I would let you read on it, because right now everyone is panicking. So
Yeah, exactly.
to read on that. But again, the intention of this lecture was not to discuss individual strategies. It's about trying to inspire you to be able to move away from manual trading. You being IIT students, you should be technically proficient enough to be able to build algorithms and let it do the work for you. Okay, and this will also prepare you very well for any job that you may be interested in finance field. This will be a great project to showcase in your interviews or your internships. Okay, So that is what I am trying to get. Okay, so if you have if any other questions are there, we can take that.
uh, how does the news, daily news impacts the algorithms we build?
Again, that's a good question. There is another there is an entire field of people who are trying to do some natural language processing, and they're
Sir,
trying to
can I say one example?
yes.
Bharti Airtel, when the 5G launched, they have launched the 5G in Bhubaneswar just 3 days back. The share was very high at around 812 or 820. Okay,
Okay.
the FNOs or options are also very high. But suddenly, when the Macquarie at the weekly expiry, I think on Thursday, they issued that the Bharti Airtel, they downgraded the Bharti Airtel, and everybody was scared and they sold it off. And it was within 2 days, Friday and Thursday, it was crashed by 7 to 8%.
Yeah, so there are a lot of algorithms out there which are trying to analyze news in real time, and they're
Yes.
trying to assess, the algorithms are trying to assess whether it's a positive news or a negative news, and also trying to assess what is the impact. And there are some very smart engineers working in on these algorithms. So there are NLP guys, people who have worked on Alexa and all those things in Amazon. They are the people who are hired to write these algorithms which are able to, there is you I hope you guys know there is a entire field called natural language processing. I have a book on that on that topic. So the whole idea is that algorithms try to understand, uh, you know, natural language, and that just like a human would interpret it, you can read one article in 1 second. Algorithm can read 100 articles in 1 second, right? So their decision taking ability is much stronger. So that is what people do. So that's another thing. That's a totally different field. And again, this is a very interesting field. A lot of research is happening, and then we can talk about the entire night on this. But just giving you an example, there was a question by someone, Malikarjun or something. He had his hand up.
So,
Okay.
sir, can we write these kind of algorithms related to the news?
Yeah, absolutely, you can. Yeah,
How
it's difficult, but you can. Do you know about natural language processing? Do you know about machine learning?
machine learning I know, but natural languages processing I don't.
That NLP is a field of machine learning. So we use neural network. Read about BERT, BERT. So Google
Okay.
has a open source package called BERT. It uses transformers to kind of analyze. You can use that to kind of read articles and come up with a decision whether it's a positive or negative or things like that. So yeah, you can get started. It's a very interesting field, but again, it's a very new field and a lot of work is happening in this area.
So those things are like bird. Those they take the data from particular
Mhm.
like articles, or every it's kind of open source. Like
You
every
kind of
article.
you can scrape open source data, but that's difficult. A lot of people use Twitter feeds to do it. But if you have money, I think there are vendors like Bloomberg and other vendors that give you kind of curated data. So that data keeps streaming. Actually, do I have this open right now? Okay. So if you trade on interactive brokers, you will see that on terminal the news keeps streaming, and you have an API to kind of get that as well. So you can get that on your Python. You can analyze the sentiment, and you can trade based on that.
Okay. Thank you, sir.
Excuse me, sir.
Yeah.
There are a few questions in the chat. Can you please answer that?
Yeah. Can you read it? I don't have access to the chat. I can't see the chat.
Okay, so the first question is, can you please send a list of the brokers that charge a low amount for API usage, given that we are hesitant to invest 4,000 to try out big providers like Zerodha for a month?
So ICICI is there, Angel One is there, Kotak is there. These three are the ones which I think are reliable. There are some which give you like fires, etc., but their API is not good. So I usually recommend ICICI, Angel One, and even Kotak for that matter. So yeah, so that's the one I would say. And then you
The
can
second one is,
research. Yeah.
yeah. Okay, you please continue. Sorry to
Yeah,
interrupt.
so, you can research. Like a lot of people are coming up, but I would suggest go with some reliable ones. So Zerodha is reliable. That's why they charge 4,000. But even Angel one is
Mhm.
pretty good, and ICICI is pretty good. Yeah, go ahead.
Okay, the second one is, what's the minimum capital to start with?
Again, when I started with 10,000 rupees. So you can
Hmm.
start because you get some leverage. If you're trading intraday, you get some leverage. So your 10,000 is actually becomes 50,000, which is a good amount of money to play with. Okay, so I mean, don't start with something crazy. Even you can start with 2-3,000 rupees. That's fine. Just buy. But the problem is that a lot of stocks, the price already is more than 5,000, 6,000. So if you have certain, because you'll buy at least one stock, right? So you need at least some thousand with you. So 5,000 and 10,000 is a good money to start with, to play around with this. And yeah, that's what I would say. And try
There
to
was
get a
one
broker.
question.
Yeah, try to get a broker
Okay,
that
yeah,
doesn't charge
sorry
you
to
money.
interrupt.
It's a free. No, no worries. Go ahead.
Okay, so can you please advise how we can profit from the upcoming recession?
Upcoming recession. Okay, so you've already decided it's going to be recession. Yeah, it's a good chance that it's going to be recession. Again, the idea is not to give you strategies right now, right? Nobody shares this strategy. The idea is for you to give them. I don't want you guys to start building trading algorithms and try to make money in the market. It's going to be very difficult. Probably out of 500 of you, 2 or 3 would be successful when you're starting out. But the idea is for you to prepare for roles in this industry, because there are a lot of jobs out there, and if you are able to build the right skill sets, you would be able to get into a very rewarding career. So that is what this lecture is all about. um, I know a lot of people are interested in getting to strategy. Tell me the strategy. Tell me the strategy. Strategy comes with time. Okay, there are no shortcuts. You will be in the market for some time, and you will understand how the market works. But the idea is for you to get a technical proficiency and start playing with these things. Is the best time for you to play with it is in the college. So because you have all the time in the world, you can build some projects, you can build a GitHub repository, and you can showcase actually to your prospective employers that I've built something like this, which would be great. So that's what the plan is. But yeah, with the recession, I have some ideas, but it may it may not work for you, but right, but I cannot share it right now. Yeah.
Okay, someone was asking to share the code which you have written so that they can learn from it.
I've shared it with you, so it depends on you whether you want to share or not, Akshat.
Okay,
Oh,
I have shared
the
the
one
helper code, the ones you discussed
I
it,
will share.
right?
I will share. I will share this. Okay, sure.
Okay, fine. Yeah, I think that wraps up with the question. Let me check if there are any more. Okay, I guess there's one more question. Can you recommend some books to know more about this topic?
Usually, Michael Lewis books are pretty good. So HFT, if you want to know, that's probably the best book. I will share a list of books with Akshat, and he can share it along with other kind of Uh, there are 5-6 books that I think help you get started with with algorithmic trading. I'll share my book list with Akshat, and then he can make it available.
Okay, sir, I'll share it once I get it. I think that's done.
Okay,
We can
great.
wrap up the.
Right
Okay,
on
it was
time.
a wonderful session.
Yeah,
Yes, sir.
yeah.
It was a very wonderful session, and thank you for coming, taking out a valuable time on this weekend.
We have one question,
I think
Hitesh.
there's one more question. Yeah.
Yeah, Hitesh Karthik.
Sir, what is spoofing in this algorithmic trading, sir?
I'll
What
just
is
explain.
spoofing?
The
Hmm.
spoofing is you placing fake orders. So if you have an algorithm which is doing the market microstructure based analysis, so you are looking at all the bids and the ask. If I start placing orders which I have no intention of honoring, then that is called spoofing. And a lot of people do that to manipulate the market. So for example, if right now the markets were open and all of a sudden I start placing a lot of big orders for HDFC on the sell side, that they want to sell, 500,000 stocks of HDFC at this price, which is just below the market, right? So it will not get filled, but it is enough for other algorithms to see that someone is desperate to offload a lot of stocks. And then as soon as the market moves in that direction, I cancel my order. So that is called spoofing. Okay. So in placing incorrect orders, placing massive orders with the sole intention of manipulating the market. That's called spoofing.
So it means it is used to like avoid losses when they're trying to buy a stock or
I
sell.
didn't get your question.
So like you are telling that like we are, some of the people will use this spoofing technique to manipulate the markets, and up to till last they will see the market, and if they don't have any intention they will leave out.
Cancel it.
Means this is
They'll
the
cancel.
strategy for
Yeah.
them to not lose lot of money while buying stocks.
They have this strategy is used to move the stock in a certain direction so that they can get a better price. So the person who was placing these spoofed orders wanted to wanted the price to go down so that he can buy it at a lower level. Okay, so that is what people do. So this usually happens for a short time. You will see that the stock goes down all of a sudden and then it again goes back up quickly. When that happens, you know that spoofing has happened. Just a blip and then all of a sudden, because there are so many sophisticated algorithms that these things happen on a real time basis. So don't worry about this. This happens only if you are working in the HFT space, and if you are working on the algorithm that depends on looking at the order books. So it usually doesn't impact retail traders like you and me if you just are interested in buying some stocks.
Okay, sir.
Are there any more questions, or can we wrap up the session?
Great, I think it's good. Thanks, Akshat.
I think, thank you very much, sir. It was a pleasure having you here.
Great. Best of luck, guys. I'll share the information with Akshat. Okay.
Thank you
Bye.
very much, sir.
Thank you.
Bye, good night.
Night.